Joining us right now to talk more about the economy is Dana Peterson, the chief economist at the Conference Board. Yesterday, that organization said consumer confidence actually ticked up in November after 3 straight months of declines. Dana, what do you see? Because it's kind of hard to figure out why yields are coming down, why the market's expecting rate cuts when things look pretty good everywhere you look in the economy right now.
Well, yes, we did have a little bit of an uptick in the overall measure, but that was after many, many months of declines, and it's still pretty low compared to what you'd like to see at this point, given the fact that consumers continue to spend. What really pushed the measure over the top was expectations. They ticked upward, but still that measure was below 80, and anything below 80 still signals recession at some point over the next 6 to 12 months.
You saw what the GDP just came in, revised higher for the GDP for the last quarter.
Yes, and that was the third quarter. We're in the fourth quarter now, and certainly in the third quarter, you had some one-offs, some really big concerts and people spending over the summer going on vacation. But now in the fourth quarter, we have student loan debts coming back in terms of repayments. We have the excess savings that consumers had really slowing down. And you also have the fact that credit card use is well above $1 trillion in aggregate, and consumers are facing higher interest rates on that. And certainly when we ask consumers point blank, do you think there's a recession? It's not as high as they were earlier this year, but still roughly 70% of consumers say, yes, we still think there will be a recession at some point over the next 12 months.
That's a Taylor Swift 5.2% number. Dana, is that what you say? Did you say in Beyonce or something? Is that which concerts?
I said it. Well, yeah, you named the two big ones, and certainly people went out and spent a lot of money traveling around.
I'd like to move do we move the GDP? No Squawk Box effect on GDP at this point yet, Danny? I would like to do that. That's pretty cool. Anyway, sorry, Dana. Cool. That's amazing.
Dana, I mean, that sounds a lot like what we heard from Rick. He's a little skeptical that the economy is as good as these numbers are showing. You sound the same way.
Yeah, when you look at other things in the GDP report, like business investment, it was barely there. Businesses that we talk to, CEOs of big Fortune 500 companies, say that the cost of capital is definitely rising. They're getting squeezed with higher interest rates, and they're not really hiring. They're not firing that many people, but they're also not really hiring away from basically 3 sectors: government, hospitality, and also healthcare. But we know those sectors are having big labor shortages. Away from that, there's really not much hiring going on. And still, when we ask CEOs, what do you think about recession? Roughly 70% of them continue to say that they expect a recession at some point over the next 12 to 18 months.
You have any idea whether that's going to be a shallow recession or one that really makes us sit up and pay attention?
Well, we've been calling for a short and shallow recession in the first half of next year, so small negatives on GDP, and then we climb out of it in the second half. But what is that characterized by? Probably negative consumption, further uptick in the unemployment rate, and roughly 700,000 job losses.
Okay. Every job lost is something we feel, but that does not sound as bad as something that would necessarily require them to cut rates really quickly.
Well, we do have 4 rate cuts or something like 100 basis points of easing for next year. We don't know if that would be in 25 or 50 basis point increments. But still, when we look at the SEP, which we know will be updated very soon, the last one said 50 basis points. So we're a little bit more optimistic in terms of the easing, but it probably won't start until the middle or even the second half of next year. And certainly that's going to depend upon the pace of inflation getting back to the 2% target. We have it getting back to 2% by the end of next year, whereas the Fed has it in 2025.